So now the part of the show where we talk about three things that I think individual investors should consider, focus on before you make your investment decisions over the next couple of weeks, 10 business days. And we have three things here. You're going to notice a technology slant or bias, and rightfully so, because technology right now continues to drive these markets higher. So the first topic is the technology sector in general. Technology, as I say, is continuing to drive the markets higher. The Magnificent Seven continue to drive the markets higher. Maybe now the Magnificent Six. A lot of people are taking out Tesla because it hasn't fared as well recently. We're going to touch on corporate earnings, the corporate earnings season. Some of the companies have reported already. Some of the biggest banks in the United States have reported. Railways have reported. Airlines have reported. We've seen about 62% of corporations that have reported beat expectations, which is below the average that we normally see. The third topic that I want to touch on are stock valuations. Are we getting or pulling to today from the future gains? So are we pulling to today the future gains that we would see in the markets? So gains that we may have seen in the second half of this year, are we pulling them forward to the first half of this year? And is this setting us up to have a weaker second half? So I think that is also important for individual investors to consider. So let's talk about the first topic here, which is the tech sector. And what I wanted to touch on right away is this Magnificent Seven or Magnificent Six, the Mag Six, whichever you want to call it, and how they continue to do well. They continue to move ahead. The largest tech stocks in the world today, largest companies in the world today, continue to power the S&P 500 ahead. But not only have we seen the Mag 7 power this economy ahead and the stock market ahead, but specifically, or more specifically, we're seeing chips, chip makers, semiconductors really do well. And I think if you're an individual investor, you need to take a look at the tech space. You need to look at the biggest tech names in the world today, but you also need to look at some of these semiconductors or chip makers. Why? Because a lot of these chip makers are involved in artificial intelligence. And as we know, artificial intelligence, the two big words that if you use them in a press conference or talk about how your company is involved in AI, that is a recipe for success for your stock price. Stock price just zooms higher. So I have a bunch of charts to go through today. And first one is Nvidia. And you can see Nvidia chart. Most artificial intelligence today use Nvidia chips. And you can see how well Nvidia has done, up to $600 a share, over $1 trillion in market cap. They're pretty much the driver of artificial intelligence. We're starting to see or hear more and more of other companies like AMD and like some other companies looking to have their own chips. Intel would be another one. But overall, I would say the dominant market share in artificial intelligence regarding chips is still with Nvidia. And you can see how well their stock has done. We have a chart, my next chart, AMD, another chip maker, semiconductor. And look how well AMD has done. And a lot of people have asked me recently, why has AMD done so well? Well, again, it is right now, in my opinion, the #1 competitor to Nvidia. And also, they do a lot more than just artificial intelligence. They have their chips in PCs, for example, personal computers. And there's a lot of talk about a PC refresh going on, getting artificial intelligence into the PCs. So that's a win-win for AMD. AMD also puts their chips in things such as Internet of Things, automotives, cars. So they're in many different places, servers. So AMD is a very large company today, having their hand in many different areas of the market and technology. Micron, another chart that we have here. Now, Micron, I guess, has obviously business to do with artificial intelligence, but Micron is considered more, they produce chips that are involved in memory, NAND memory. So memory, having memory in your computer, that's what Micron does. And you can see how well Micron has done in the past, let's call it 3 months or so. Stock was down in the 60s. Today, it's getting closer to 90. So again, another chip maker, another semiconductor that has had a tremendous run. The last one I'm going to show for you today is a chart on Qualcomm. Qualcomm, another company that's going to benefit, that has benefited from artificial intelligence. Qualcomm, obviously, their chips, we know them for going into handheld devices, your phones to get your 5G. We also know Qualcomm has also moved into the automobile space with chips in the automobile. And we also have been hearing rumblings that Qualcomm is going to benefit from a PC refresh, and they're starting to get their chips in more and more places as well. So when we look at technology, in particular, some of the semiconductors, we know that these are the companies that have been powering the market ahead. And in my opinion, I think if you're looking for growth in a portfolio today, you need to look at technology. It's not like technology is going away. It makes up the largest component of the S&P 500 today, not the largest component of the TSX, of course. That is more for banking. But on the S&P, US markets, tech is the biggest sector. And I think it's something that you definitely want to consider before you make your investment decisions. The second topic I wanted to touch on is the topic of corporate earnings. And we know that we've already seen about 10%, as I mentioned earlier, of corporations reporting earnings. And earnings have been mixed. We've seen about 62% beat earnings expectations. That's down from about 77%, which we normally see. Normally, we see between 75 and 80% of companies beating the expectations, beating what analysts are expecting their companies to report. So what does that tell me? Well, it tells me that things are slowing down, which we already knew. We knew things were slowing down in the economy because we're seeing inflation come down. We're hearing the Federal Reserve, the Bank of Canada, talking about the economy slowing. So that's playing out or being reflective on these earnings and earnings season. However, one company that just reported that actually saw a tremendous increase in their business is Netflix. And we have a chart on Netflix today. And here it is. Stock price now, I can tell you, is over $500 a share. Netflix reported over 13 million new subscribers. It is the largest increase in subscriber, largest growth that we've seen for the fourth quarter ever. And it is the largest amount of new subscribers that Tesla has taken on since going back to the COVID days when everybody was at home and everybody signed up for Netflix. So Netflix stock is way up today, up last time I checked, over 11%. Now, a tremendous company, a very large company, leader in their space. So looking at corporate earnings such as Netflix, do you want to own Netflix today? Well, might be difficult since they've already had a tremendous run higher and they're trading at high multiples. Another name that is about to have earnings is Tesla. And we have a chart on Tesla here. Tesla will report earnings tonight. And Tesla is all about how many cars can they sell? Can they produce to sell? What are their price points on their cars? I heard rumblings today that Tesla is about to produce a car to be sold in the US that will cost people $20,000. $20,000 to get into a new Tesla. That's unbelievable. That means it probably cost us $25,000, $30,000 to buy a Tesla up here. I can see more and more people getting into a Tesla if it becomes a lot more affordable. In general, we know EVs, electric vehicles, are expensive. We've heard from Maureen Harkwell late last year talking about how expensive EVs are and some of the complaints that we've seen with respect to electric vehicles. We also know that Tesla is losing some market share in China. We've seen Tesla, which once upon a time had over 90% market share, now down in around 60% and maybe even lower than that. So Tesla is trying to find ways to stay competitive, to be more and more competitive, and to sell more cars. So their earnings will be crucial. But again, next week, we're going to have the big tech earnings. We're going to have Microsoft. We're going to have Amazon. We're going to have Google. Those earnings will go a long way as to how the tech sector performs and also the market as a whole, the S&P as a whole. I think Apple is shortly after that as well. And we know Apple, Microsoft, tech earnings, biggest companies in the world, very important to the stock market. So before you make your investment decisions, keep in mind some of these corporate earnings. Listen to what the CEOs are saying on their conference calls. Listen to what these companies are reporting, their top line, their revenue growth, and their bottom line, their earnings per share. So when you factor out the expenses and how much they're paying, how much are they earning bottom line? And I think that is very important before you make your investment decisions. The third topic I wanted to touch on, and I've touched on this many times, but we're kind of taking a bit of a different slant to it today, are stock valuations. Have we pulled forward the gains of, I guess, 3, 6 months from now? Have we pulled forward those gains to today? And that's, I think, a lot of people's worry. A lot of investors are worried about that because we're starting to see certain companies' PE ratios start to be a little bit stretched, a little bit more stretched than they used to be before. Just a short while ago, back in the fall, we're starting to see the price of the stocks in general on the stock exchange, New York Stock Exchange, even in some places on the Canadian or Toronto Stock Exchange, start to get ahead of its earnings. So a couple of stocks I wanted to point out. We have a few charts for that, talking about stock valuation. First one is Amazon. I love Amazon. I think Amazon's a fantastic company. It continues to be a top pick at many investment houses or with many investment houses in the United States today. Amazon trading at just under $160 a share. Last time I checked, it was higher this morning. And it's a name, though, that I have here trading at a PE ratio of over 50 times. Now, once upon a time, it was over 60 times. And then when the market pulled back, it got down a lot lower than that. But now it has surged. Price to earnings ratio, meaning the earnings are not keeping up with the price gains. And I know that everyone's talking about Amazon as a future opportunity, and I believe it is. So I continue to buy Amazon, but a little bit more cautiously because I'm seeing that from a stock valuation basis, it's getting a little bit frothy, a little bit high at this point in time. Another name I wanted to touch on, which we have here, is Alphabet or Google. Now, Google trades at 26 times earnings, so a lot cheaper than an Amazon does. It's growing their cloud business, for example, somewhere around 26% a year. It's growing its top line. Its profits are growing in that 25 to 30% range. So are they as expensive as Amazon? Probably not. And Google is a name that, if I look at the Mag 7, the top 7 companies, top 7 tech companies that have been pulling the stock markets higher, I think Google is probably one of the cheaper names, and a name that, again, for those that can handle the risk of owning a name like Google in their portfolio, I think it's a name you want to consider. However, we're noticing that just a little or short while ago, PE on Google or Alphabet was in the low 20s, and now it's creeping up into the high 20s. So again, from a stock valuation perspective, you're going to have to do your homework, find out what the growth rates of some of these companies are to see if these companies are growing at a reasonable price. GARP investing. I am a GARP investor. Growth at a reasonable price. The third stock I have here is one I've shown many times, and before I came on the air, I was talking to some of my assistants, and we were talking about Meta, how Meta actually touched $400 a share to just this morning. And Meta, another name, trading at 27 times forward earnings. It's a name that I continue to look at, and on dips, I continue to buy. 2 billion users of its apps on a daily basis, so more than 2 billion users of its apps on a monthly basis. You figure there's 8 billion people in the world today. A bunch of those don't have internet connection or access to internet. So it is quite possible you're looking at, a good percentage of the world using Facebook or Meta apps on a daily basis, which is such a powerful tool. And Meta has continued to go up, up, and up. You can see here by the chart. And their PE multiple is also starting to rise. Their PE multiples were under 20 not too long ago, just over 20 not too long ago. And here we are in the 25 to 30, 25, the PE of 25 to 30. And so for me, valuations always continue to matter. If you're an investor today looking to make investment decisions, valuations always matter. You want to look at growth. You don't mind paying up for growth, but you want to do it at a reasonable price. And I think the last chart that we have here, which talks about price versus earnings, which I think is a fantastic chart, probably my favorite chart of the show, and that is the S&P 500 change in forward 12-month EPS, earnings per share, versus a change in price over a 10-year period. And you can see what periods of time price got ahead of earnings. And you can see for a while there, that I guess from, what was it, 2021, 22, prices started to go, sorry, 2021, prices were elevated above earnings. You can see in 2022, prices came down below earnings. So things became a lot cheaper in 2022. And we talked about that, how companies were doing well, still doing well, but because interest rates were moving higher, investors didn't care how well companies were doing. They just focused on higher rates. And so prices came down, earnings hung in there, stayed relatively upbeat or higher. And so prices went below. And here we are. If you look at the right-hand side of this chart, the last part of the chart, you see prices going well above earnings per share. Now, does this mean you should go out and sell your stocks if things are getting expensive? No, absolutely not. This is just a general commentary on the markets in general. Within the market, I think there's still a lot of things that are cheap. As I told you, I still think within the Mag 7, which is probably the group of the most expensive stocks that exist on the S&P 500 today. But I think within that group, I still think there are companies that are relatively cheap as well, such as Google. So in my opinion, you want to look at stock valuation, but you don't want to get carried away and say, oh, market's at all-time highs. It's not a good time to buy, because when you look at stocks or the stock market at all-time highs, and if you were to think about, oh, this is as good as it gets, and you were to sell, we know that when a market reaches all-time highs, 12 months later, it is usually even higher, maybe as much as 10% higher. And we know that markets go higher over time. So if you're about to sell just because we reached a high point, I think that is a mistake. I think you want to evaluate your companies on a constant basis. You want to make sure you're buying businesses, buying investments that are trading at a reasonable price that are showing growth. And I think if you do that, and if you do your homework on stock valuation, that is the best recipe for future success.